We now have in place all of the pieces of our model of the macroeconomy, and we're ready to put it to work. What we're going to do now is tell some stories about how the economy adjusts in response to some change in the environment. And for every story we tell, there are going to be three parts. First, what happens in the short run? Second, what happens during the adjustment process when prices are changing? And third, where do we wind up in the long run? Now, when you look at this model, you can see that there are only three things that we can shift. We can shift the aggregate demand curve to represent a change in planned spending in the economy. We can shift the short-run aggregate supply curve to represent a change in expectations or a change in long-run aggregate supply. And finally, we can shift the green curve itself. And anytime we shift the green curve to represent a change in the economy's potential output, we have to take the blue curve with it. So let's now do each of those three possible shifts and tell the stories that go along with it. And along the way, we're going to be reviewing everything that we've discussed for the last several discussions. So let's start then with a shift in aggregate demand. A shift in the aggregate demand curve comes about because of a change in the planned spending of consumers, businesses, the government, or perhaps a change in taxes that's going to influence consumer spending. It could also come about because of a change in the spending plans of foreigners and our net exports. And finally, a shift in the money supply on the part of the Fed will influence the interest rates and change planned investment spending. So anytime any of these variables change, they're going to show up as a movement of the red curve. So let's suppose now that there's been an increase in aggregate demand. Consumers want to spend more. Businesses feel confident about the economy and are investing more. The government increases its spending or lowers taxes. Foreigners decide they want to buy more of our products at every price. Or the Fed increases the money supply, reducing the interest rate and stimulating investment spending. This would be shown then as an increase in the aggregate demand curve. So we'll label our original AD0 and our new curve AD1. With this change in aggregate demand now, we're going to get three sets of consequences. The first set of consequences is going to be the short-run consequence. We start with a price level in equilibrium of P0. What happens then when aggregate demand increases is that we have excess aggregate demand. That is, at the original price level, the quantity of goods and services that everyone wants to buy exceeds what businesses are producing. That is the point on the blue supply curve where producers are operating. This leads then to an increase in prices as competition for goods and services bids up prices. As the price level rises, we have a response on both sides of the market. Over here, the rising prices shrinks real wealth, increases the demand for money, pushing up interest rates, and raises the price of our goods relative to foreign goods. All three of these effects reduce the quantity of goods and services that people want to buy as we move along the aggregate demand curve. Businesses respond to the higher price level by sensing profit opportunities and increasing their output. That is, wages are sticky, prices are sticky, and firms are confused. So they make more stuff as prices go up. And that leads us then, in the short run, to a new equilibrium point. And this new equilibrium point we will label P1. So in the short run, what happens is the economy is going faster than its speed limit. That is, Y1 is greater than the full employment level, Y sub F. Now, because Y1 is greater than YF, this short-run position is unsustainable. And what we get then is an upward movement of prices. Because we are exceeding the speed limit, the price level begins to rise. Firms begin to compete aggressively for workers and raw materials, pushing up prices. Now, what happens then in the adjustment process is the rising prices, the increase in wages, and the passage of time cause the blue curve to begin to shift upward. That is, as firms have to pay higher wages to attract workers and the competition pushes the wage level even higher. As firms have to pay higher prices for raw materials. As time passes and labor unions renegotiate their wage contracts. As firms have the opportunity to stamp new prices on their products with the passage of time. And finally, as firms figure out that it's not just their prices that have gone up, but all the prices in the economy, everyone begins to pass these higher prices along. Everyone decides, they form the expectation that inflation has set in, and people begin to raise their prices in anticipation of even more inflation. So the price level goes up with the passage of time, and the fog clears, and everyone realizes that we're in inflation. With inflationary expectations setting in, the short-run aggregate supply curve keeps shifting upwards until we get to the new short-run aggregate supply curve. And I'm going to label this SRAS infinity, because we get to this curve at the end of the adjustment process. There are going to be intermediate steps along the way. The curve will shift up, as I just showed you. That is, we're going to move along the aggregate demand curve as businesses cut back their production and raise their prices. And finally, we wind up at this new long-run macroeconomic equilibrium where the red curve intersects the blue curve, intersects the green curve. So, in long-run macroeconomic equilibrium, firms pass the rising prices on to their customers until aggregate demand is choked back to full employment. Long-run macroeconomic equilibrium occurs where the blue curve and the red curve cross on top of the green curve. That is, we're not in long-run macroeconomic equilibrium until we have returned to full employment and the prices have stopped rising. This is what long-run adjustment looks like. Now, of course, there's the question, how quickly do we get there? And that depends on expectations. If expectations are adaptive, then it may take a long time because people are basing their notion of price changes on what's happened in the previous period. So prices adjust upward gradually. People keep increasing their prices at the same rate that prices increased last year. On the other hand, if expectations are forward-looking and rational, then we move immediately to the new short-run aggregate supply curve because people see that we're past full employment and they raise their prices immediately. They raise their wage demands immediately to get here so that they're not left behind. People anticipate where the economy is going to wind up, and they make choices right now that move the economy immediately to that point. One of those choices would be a choice about investment demand. Firms say, well, we're at a point right now where there's a lot of demand in the economy, but we know prices are going to be rising, and when prices rise, people aren't going to buy as much stuff. Plus, interest rates are going to go up, so firms say, whoa, we're not going to invest. We're going to cut back our purchase of plant and equipment and tools so that we don't get stuck with a lot of excess capacity. So anticipating that prices are rising lead businesses to invest less, and that's part of this decrease in aggregate demand. So people are making decisions in a forward-looking fashion. That causes the adjustment process to be very quick. On the other hand, when people are making decisions based on what's happened in the past, adaptive expectations, the adjustment process may be slow. Let's consider something else that can happen in the economy. We've shifted the red curve. Now let's do a change that involves the blue curve. This is what's called a supply shock. A supply shock occurs whenever the price of some important input increases dramatically. So suppose we have an increase in the price of raw materials like oil, or an increase in wages due to a sudden surge of strength of labor unions. If that happens, then we show that as an upward shift in the short-run aggregate supply curve. Because of the higher price of inputs, businesses are going to charge customers higher prices for outputs. And as that happens across the economy, we get a new short-run aggregate supply curve representing higher prices. Well, what's going to happen in this economy if we have a supply shock? What's going to be the consequence? Well, let's suppose that we start with a macroeconomic equilibrium in the long run of price of P sub 0, and we're at full employment output. Because if you're not at full employment output, you're not in long-run macroeconomic equilibrium. If we're here to start with, and the supply shock causes businesses to raise their prices and reduce their output, the initial situation is one of excess aggregate demand. People are still buying at the point on the red curve, but businesses want to supply at the point on the blue curve. With this excess aggregate demand, prices are pushed up. And as prices rise, businesses, consumers, and foreigners cut back their demand. Businesses, meanwhile, because of sticky wages, sticky prices, and confusion, increase their output until, in the short run, we find ourselves at this point, P1, an increased price level, and this output level, Y1, which is below full employment. Well, because we're below full employment now, we have downward pressure on prices. wages and prices tend to fall because of unemployment and slack in the economy. What's going to happen then is that businesses pass these lower costs on in the form of lower prices. Competition leads businesses to lower their prices because wages are falling until we return to the original short-run aggregate supply curve. That is, we're going to be below full employment until the short-run aggregate supply curve moves along the aggregate demand curve, dragging equilibrium back to its original point. So, whenever you have a supply shock, there's going to be a point at which you are below full employment equilibrium in the short run. That is, you're below the long run full employment output. However, because you're in a slack economy, prices are going to fall and the short run aggregate supply curve moves outward or downward as businesses pass these lower wages and lower costs on to customers in the form of lower goods prices. So because we're on this side of long-run aggregate supply, prices are falling and the blue curve is moving downward back to long-run macroeconomic equilibrium. Well, what happens is the price level winds up exactly where it was before. Even though oil may be more expensive, the price of everything else falls until the price level returns to its original level. So a supply shock can give us a temporary period of unemployment and higher prices, but in the long run, everything else adjusts to bring us back exactly where we were to start with. This is the response then of the economy to a supply shock. Once again, the speed of adjustment depends totally on expectations. If people have adaptive expectations, the adjustment period is slow. If they have forward-looking, rational expectations, they immediately see where the economy is going and they make the decisions now that will actually lead to this outcome occurring immediately or very, very quickly. One more possibility to consider. What if the productive capacity of the economy actually changes? What if the green curve shifts? The factors that could lead to a shift in the productive capacity of the economy are, first, an increase in our pool of inputs. What if immigration increases labor, or the accumulation of capital through investment increases our productive capacity? Also, the green curve shifts outwards if there's an improvement in technology, allowing us to make more output with our given inputs. Finally, big changes in the environment could influence our productive capacity. For example, if there's a war that decimates the capital stock or reduces the labor supply, or bad weather that simply allows you to produce less with what you have. Any of these changes are going to shift the green curve by changing the economy's productive capacity, changing the speed limit. Now, one thing to keep in mind is that anytime the green curve shifts, it takes the blue curve with it, because these two curves are stuck together. That is, any change in the economy's productive capacity shows up both in the long run and immediately in the short run. So, for instance, suppose there's an improvement in technology that shifts out what the economy can produce. What you're going to get is the long-run aggregate supply curve shifting out and taking the short-run aggregate supply curve with it. So let's actually now draw those curves and consider what happens first in the short run and then in the long run. So here's the new long-run aggregate supply curve. It's a vertical curve just like its predecessor, and that means our full employment output has moved from YF0 to YF1. With new technology, we can make more with our given inputs. So let me go down here and label this new green curve long-run aggregate supply curve 1. This is its new position. Now, the blue curve came right along with it, as we saw just a moment ago. So let me draw it in. Here's short-run aggregate supply curve 1. The new curve is shifted outward. That is, with the increase in technology, at any given price level, firms will produce more output than before. Now, what happens to output? Well, first of all, in the short run, we move along the aggregate demand curve to the intersection of the red and blue curves. As you figured out, this is where we always go. We're always going to be where the red curve and the blue curve cross. So originally, we had a price level of P0. After the technological change, we have now excess supply. That is, firms are producing a lot more given their new technology and lower costs, so there's more stuff piling up than people want to buy. This puts downward pressure on prices, leading businesses to cut back their output relative to what they would have produced at the higher price level. And as prices fall, consumers and businesses want to buy more. So the new price level in the short run is going to be where the red and blue curves cross at this point P1. However, relative to the full employment line, we're still below potential. That is, because we are below what the economy could produce with all resources employed, there's going to be downward pressure on prices. Prices are going to tend to fall because we've got unemployment, because we are on the left side of our full employment curve. And as prices fall, we represent that in this picture by a downward shift in the short-run aggregate supply curve. Because there is slack in the labor market and slack in the market for material inputs, the prices of those inputs is going to fall, and firms in competition with one another will pass those lower costs on to their customers in the form of lower prices. Eventually, we get to this point right here, short-run aggregate supply infinity, where the short-run aggregate supply curve winds up when all the price adjustment is done. This is our new long-run macroeconomic equilibrium. Long-run macroeconomic equilibrium occurs at the point where the red and blue curves cross on top of the green curve. We've now got no more price pressure. Look what happened in this case. Prices fell and output increased. Our standard of living unambiguously improved. That's what happens when technology shifts out the green curve. And this is the idea behind supply-side economics, which we'll be discussing later, is that if you change the productive capacity of the economy, you can get lower prices and larger output. Once again, how long does it take us to get from SRAS 0, the original equilibrium, to this new one in infinity? Does it take forever? Well, it might if expectations are adaptive and people keep looking backwards, letting adjustments occur in a slow process. But if there are rational expectations, people see that this is where the economy is going, and competition pushes prices down now, businesses invest more in anticipation of the boom, and people start spending their newfound wealth even before it's completely in the bank. So with rational forward-looking expectations, the adjustment process is very rapid. With backward-looking adaptive expectations, it could take us a long time to get here.